Hello, everybody. Thank you so much for joining us today. Welcome to the Real Life Real Estate Investing Show. I am your host, Hector Hernandez, and joining me today is my buddy, my pal, and 2022's best looking real estate investor of the year, Luis Alejandro Lopez.
How you doing, guys? Happy Friday to everyone. Yes, I'm Luis Alejandro Lopez. I am a real estate investor and coach here in Real Life Trading. And we got an amazing show for you today, really. So
it's going to be a really good show. We got a special guest and all sorts of stuff. But before we get too deep into that, can you all tell me if you see my screen there? What you see? Okay, you see the show, the slideshow?
Is the beard.
The what?
Man, that's looking one because of the beard. Come on. But it is.
All right, perfect. Right. Let's do slideshow view so you guys see the good stuff. All right, before we go too far, guys, please remember that everything we cover here today is for entertainment purposes only. It is a lot of fun. I'm sorry?
And education purposes.
And education, yes, absolutely. We're just two random dudes on the internet. Please make sure you know what you're doing when you're doing it. Do not take investment advice from us. All right, Luisito, what is the real estate market looking like out there?
September, we had last Friday, the previous show that we had, basically the Fed cut up the rates another 3/4 of a point. So the current rate has not changed for October. They do not meet in October. So the current rate is still at 3.25. We have two more meetings in November 2nd and December 14th. Everybody is expecting another 3/4 points in November, or the 3/4 points in December. Okay, they might do both. Nobody really knows yet. We had 2 days ago, the Bank of Canada was expected to raise the rate 3/4 of a point as well, and they just did 0.5%, and the market went rampaging. That was on Wednesday, if I'm not mistaken. I think we all saw the big red candle went up, like a lightsaber. All right. Now, on the other news, September pending homes fell 10% month to month, and they fell 31% year to year, which is a lot. Okay, part of the issue that they're falling is that with the mortgage rates of 7.12%, a regular mortgage of $300,000 went from being $1,200 a month to almost $2,000 a month. So what the Fed wants to do, which is shrink the affordability of homes, they're getting it done, right? Now, the other issue what the pending homes are still falling is because people do not want to sell their homes. There's a lot of people there that have the 2% mortgages, 2.5%, 3.25%. They do not want to get rid of those mortgages. So we are expecting a lot of people try to stay in their homes for a while. Now, life is going to happen. People have to upgrade, downgrade, move, etc. But for the most part, that thing that people just want to move because they want to move, they're going to hold back in this cycle, at least at the beginning. Okay. The other good news that I saw when I was looking at the stats is, even though we're starting to see the decline in the market, 19% of buyers in September still waiving inspections and waiving appraisals. So what that means is that they're coming in, I want it, I don't care, I want it, I want it, I want it, I want it. So 1 in 5 people are buying the homes blind. Okay, they don't care about the price, they don't care about the condition. So that tells me there's still a seller's market out there.
There's still plenty of demand out there for J Payne to destroy.
Yes, there's still a seller's market. Even though the pending homes fell, everybody was going nuts buying homes. So we are basically in the bubble, and we're starting to get back into normal. The average rate, again, the 30-year fixed mortgage is 7.12% today, down from 7.25 last week. So it's going to hover there for a while. Let's see what happens when Jay Powell raises the rates, next month. But again, he is expecting to put us and everybody in pain. And he's looking to slow down the market. However, he's not accomplishing as of yet. You wanted to say a couple of things as well, right?
My bad. Yeah, absolutely. I just hit the wrong key over here. Let's see. These are the stats here in Florida. Tell me if you guys could all see that. Give me a couple ones if you can see the September 2022 residential stats.
Yes. See it.
Boom, here we go. So this is essentially what we are looking at. This is for Stellar MLS. They particularly look at, I would say, about 80% of Florida. They're one of the largest MLSs here in Florida. So this is what I look at very often and all the time. Active days on market. It's gone up. It's gone up right there, 32% and 23% month over month. So it's definitely things are sitting a little bit longer, where a couple months ago you were selling properties at the
You were
open
lucky
house.
to get something in the contract. So again, it's not like the things are falling off a cliff. It's returning back to normalcy. You know.
Exactly. Yeah, it's slowing down for sure. The question is when the cliff is coming, right? So we keep an eye on these things because we're always worried about the amount of active listings, how long they're sitting. As you can see, the amount of active listings is down a little bit, just a tad, not really a whole lot, month over month. And that basically goes to Lewis's point that less and less people are wanting, have a desire to sell unless they absolutely have to. They're just going to hang on to that sweet mortgage, even if they didn't refi in the last 2 years and, they got their 2019 4.5. That's still pretty good compared to the 7.0 of today. You can't really.
Again, the same house, the same price, $300,000 is a jump in $700 a month payment. So that's what, car and a half payment right there. That's a Tesla. If you put it away. So they're not gonna, if they don't have to, people are just gonna stay in their homes for a while.
Exactly. And then if you can see where my mouse is hovering right here, months of inventory, it's up to 3 months. Still very much a seller's market. It has not even hit the equilibrium yet. So we are definitely climbing. I believe the last time we looked at this, we were around 1.5, 2 months. So we're getting a little bit higher, but it's as a matter of fact, right there, August was 2. The last time we looked at it. Now we're inventory is increasing a little bit more. And what that means for those of you that did not catch that explanation last month, essentially is how many months is going to take to absorb the current amount of listings on the market. If nobody else listed, every property out there would be gone in 90 days and gobbled up by buyers. Any questions, thoughts, of concerns on that? Just throw me some comments in the chat before we get too far from it. Other than that, I did look at Redfin a little bit, and they have the Florida, this is specifically in Florida, this is all housing types. Since June, we've gone down a little bit, a tiny little bit, from 410 to 390 as far as the average home goes in Florida. So we still, it is a far cry from the 350 of October of last year. So we're still relatively solid in terms of values. They have not dropped a whole lot. This is one of the points that you were making, Lou. Pending home sales fall 35%. That's the largest year-over-year drop in since 2015. Yeah, since October of 2015. And again, it's hard for things to go under contract, so they take longer to hit the pending status, and that's what this is measuring right here. And it also measures the fact that there's less people listing their homes, like we said. And I believe you made a point about this one right here on the screen, Lou, right?
Correct. That's a big point. That's exactly what Jay Powell wants to break. They were a lot of money. Remember, a lot of people refi houses. They used the curve to refi. So they were cashing out all of the stuff. There's still a lot of people that have equity. So you have equity. Let's say you want to move to a similar house in another neighborhood, in another city. You're going to be paying $700 more a month for the same price house. So people are just going to do it unless they're forced to. Okay.
You just sit tight unless you really have to, or you get a really good job and somewhere else. So,
yeah, unless life happens.
There you go. That's a good way of putting it.
Yeah. But for just wanting to do it, a lot of people are not gonna do it. Okay.
All right. Any thoughts or questions on the market? Does anybody have any specific questions? If not, we can go ahead and start moving on. Kim, if you are on, just let me know if you're ready to go. We can get started.
She is on. Mute. There you go. I just unmute you, Kim. So you should be ready.
Well, she may have stepped away, so
No,
we
she's
could give
texting.
her-
Here. I'm here.
There you are.
There you are. Good.
How are you today, Kim?
Good.
Welcome to the Real Life Real Estate Investing Show.
Thank you.
Oh, let me allow your video. Sorry.
He's the host. I'm
There
guest
you
today.
go. That would be smart of me.
There we
you
go.
Hello. How are you? Happy Friday.
Hello.
Hey, hello.
It's good to see you.
Excellent. Yeah, I'm super happy to be here. Thanks for the invitation. Seems like a pretty lively audience. That's great.
Absolutely. We have,
we have a bunch of-
a nice group of investors all around. They're all very fond of the stock market and real estate alike. So they're definitely going to be excited to hear what you have to say. So obviously, I can say a bunch of stuff about you. You are by far my favorite corporate securities attorney. Amazing educator. You've added so much value to mine and Luis's life over the last little over a year now since we've started working together. And I really, truly do appreciate you for all that, but also for being here and sharing your knowledge. Sochi says, welcome to RLT, Kim. Thank you so much. But why don't you tell us a little bit about yourself before I butcher it?
So I'm a corporate securities attorney. I founded a law firm called Syndication Attorneys PLLC in Florida in 2016. Prior to that, I was a partner in a California securities law firm from 2010 to 2016. Actually started practicing real estate securities law in 2008. So this really has just been the focus of my practice since 2008. I'm licensed as an attorney both in California and Florida. I'm also a licensed real estate broker in Florida. So we have clients all over the country. Everything our firm does is primarily under federal law. So we're able to help clients anywhere who are raising money from private investors.
You're also the author of a #1 Amazon best-selling book.
Yes, called How to Legally Raise Private Money. It's available on Amazon if you want to buy it there. If you want a free digital copy, you can get that at our website at syndicationattorneys.com. There's a free book tab. And then, yeah, we also have our podcast. It's called Raise Private Money Legally. Every month, I interview someone with a product or service related to syndicators. So it's services and products that syndicators need as their businesses grow, or I teach a topic related to some aspect of raising private money.
And if anyone out there has any aspirations of either raising capital or investing as an LP with syndicators, you should absolutely both read the book and listen to the podcast. It is gold.
Yes.
Free, like super valuable information.
The book, actually, the last chapter of the book is dedicated specifically to passive investors. And my theory on that is that if you learn what other syndicators are supposed to be doing, how they're supposed to structure their companies, what kind of securities compliance they're supposed to be doing, then you're going to be able to spot those that aren't doing it right. And once you see those red flags, you'll know that's not a good investment. Stay away from those people. They're likely to get in trouble. And you'll be able to spot the ones that are following the rules.
Absolutely. Yeah, we hit a little bit on the topic last week in terms of what the syndication world is and real estate funds and all that good stuff. And then today we're going to dig in a little bit into that. Obviously, your book goes into way more depth. So this is just going to be a surface level type stuff, guys, where we'll cover a little bit of the legalities of things, but definitely recommend checking out the book. But Kim, everyone wants to know, what does a corporate security attorney really do?
So we set up companies for people who are going to raise money from private investors. So we'll set up the company and we'll provide the operating agreement that has all the right provisions in it between the management and the investors. Talks about how the different members are going to be taxed, and who gets to make decisions, what decisions the investors get to participate in, what things the manager does to run the company on a day-to-day basis. And it's really just a governing document for how a syndicate, so a real estate syndicate is just a group formed for a common purpose. So we use this in the real estate context when we form a company that's going to have a group of people who are both management and passive investors. So that's how the term syndication is used. The securities compliance aspect of it is the other part of what we do. So we form and structure the companies with investors, and then we also do the securities compliance, which is making sure that the person who's raising the money or the company that's raising the money is following the correct securities laws. So securities laws come into play when people are raising money from passive investors who are not actively involved in generating their own profits. When they're relying on the promoter of the offering to generate the profits on their behalf, then they're creating something called an investment contract. And that investment contract is a security. So now that triggers having to comply with securities laws. And what that really means, I guess that's going into our next question, right? What is securities compliance? What that really means is that you have to provide proper disclosure. So the investors are entitled to all the information they need to make informed consent. So that's all of the material facts about the property, the people who are promoting the property, the people who are going to be managing it, so the syndicator, and all of the people that are participating in it. So if there's anything that the syndicator is not sharing with an investor that could later cause that investor to say, I would not have invested if I'd known that, then those are the kinds of material facts that the syndicators are obligated to share. And so how that's done is usually there's a document called a private placement memorandum, and the format of that is prescribed by the Securities and Exchange Commission, and they tell us, what has to be on the front cover, what has to follow the front cover, what has to be, immediately following the table of contents. They're pretty specific, but they really want to know, who are all the members of the management team, what kind of percentage interest do they have in the management team to know what kind of influence they have over the decision. We actually require all of our clients and everyone in their management team to undergo a background check, because part of that is making sure that you don't have bad actors in your syndicate who are going to have some influence over that deal. And that's both an SEC rule that you have to prohibit such people from participating in that capacity, and then also just to protect the investors and all the other members of the management team from unscrupulous people who might try to get in and do some illicit thing.
Perfect. So what we're doing is protecting everybody from people that are just looking around trying to get the money without much explanation. The whole idea, we were talking this week about another Kim Kardashian. She was doing all kinds of legal stuff, it seems. Now, for her, it's, if she gets a fine, she writes a check, and, that's a Friday's expense bonus for her. But what happens if you get caught doing something, completely wrong? Or on the other hand, what do you need to do to prevent getting into trouble with the SEC? Because, me and Hector, when we first started, we were doing that. We were raising money. Hey, I got a deal. Let's find somebody that wants to give money. And after talking to you, we'll learn our ways and then we'll do everything properly. So what are the steps that somebody that wants to start, they found a good deal, where do we go now to, okay, let's raise the capital legally so nobody gets in trouble and everybody gets their money?
Yeah, so the first part of that is really there should be some pre-education, to learn, because the rules are a little bit complex. There's both the corporate structure and there's the securities compliance, and you really have to learn both those things. And then there's some rules on how you can market and who can be in those offerings. So what it means is when you're selling securities, you are obligated to either register the offering, which means getting pre-approval from regulators before you even offer it to anybody, or to qualify for an exemption from registration. And so the registration process is very long and drawn out. It's the process that companies go through to become public, right? So it's the initial public offering, they get pre-approved. That whole process can take, 6 months to 2 years. And so for real estate investors, it's not practical because they typically have 90 days from the time they get a property under contract to when they have to execute the purchase. And during that time, there's a lot of stuff going on. They've got to, conduct due diligence on the property, make sure it's what the seller said it was, make sure it makes financial sense for their investors, make sure they understand all the repairs that need to be made so that their budget isn't going to be astronomical, and, figure out how much exactly they need to raise from investors in order to be able to pay for the down payment, the closing costs, their capital improvements. So that's whatever things they want to do to improve the property, plus legal fees and any pre-closing expenses. So there's going to be some consultants that are hired to do property inspections and things like that. And then also to have some money in the bank for working capital and reserves to run the company. So that typically means that they've got to figure out all of that. And then they've got to do what's called pro forma on the property to make sure that that property is viable, year over year. What is that property going to do as far as income? And of course, these are all projections based on the syndicator's best estimates. And, you can't predict things like interest rate rises and, depressions and rent control and things like that are beyond your control. But those are part of the things that we talk about in the private placement memorandum, is that there could be these regulations that could change, or tax laws that could change, or economies that could change, that could cause these projections to be wrong. But based on what we know right now, and then this is how we think the property will perform over the next 3 to 5 years, or however long you're planning to hold it. And then there's usually some proposed exit strategy where we're talking about, what are we going to do? Are we going to sell it? Are we going to 1031 exchange it? Are we going to hold it forever? And so investors have a good sense of what has to happen before they get a return on their investment. Do they get some returns from cash flow, or do they have to wait until there's a sale? And then also what has to happen before they get their money back, which usually happens when there's a sale or maybe a refinance on that property. So that's typically how all that goes. But just back to your point about Kim Kardashian.
Yes, please. Because everybody is in the audience is very excited. I posted your article, by the way, in the Slack that we all share. And it was a little bit of a conversation for sure.
Okay. So what Kim did, and Kim has a stake in this because she wants to be an attorney. And so she's working towards becoming a licensed attorney. She's working underneath a licensed attorney versus taking the law school route, which some states allow, California being one of those states. So she can't afford to have a securities violation on her record, because that could get her labeled as a bad actor who would never then be able to do any further kind of promotions or raising money for any other kinds of companies. So what Kim did is she got approached by a cryptocurrency firm, I believe, to help promote their offering. And all of these securities compliance rules that I'm talking about are embodied in something called the Securities Act of 1933, which was enacted in the wake of the stock market crash, where a lot of people lost money and there was no overarching federal law. There were individual state laws that prohibited people from defrauding investors, but all you had to do to escape prosecution was to hop state lines, right? Go from Alabama to Georgia, and now you're not in trouble anymore, right? Just don't go back to Alabama, right? So that's when the feds came in and said, no, we need a federal rule that makes it a federal crime to defraud investors, and therefore people can't escape prosecution. And this is when they came up with those rules about you've got to be able to give people all the information they need to make informed consent. You hear tales about people selling the Brooklyn Bridge and swampland in Florida, things like that. So, this is when that all went away, and they said, no, we have to protect these investors. So the Securities Act of 1933 was born. It has been updated and revised multiple times since then, but it's still alive and well. And some of the rules that were put into place in the Securities Act of 1933 are being applied to crypto offerings, much to the chagrin of the cryptocurrency promoters, right? Because they all think that this is an archaic law, it shouldn't be applied to us. What does it have to do with us? And of course, they all want to use blockchain and have anonymous transactions transactions and, all of that. And the feds are very resistant to that for a variety of reasons. One is there's no protection for investors. Two, there's no way to tax them. Right? You don't know who they are. How are you going to get taxed?
Sam wants to get paid.
Right? And they also have a very vested interest in prohibiting money laundering. Okay, which if there's no transparency and everything is anonymous, then anybody can invest any amount of money anywhere and nobody has any control over it. Now our laws can be actually used to help people promote these offerings. So that's why the Securities Act of 1933 is being applied. The current securities commissioner was recently asked how many crypto offerings out there are under investigation, and he said, well, all of them. All of them. So I think the feds are really kind of leaning in the direction that at some point they'd like to have crypto only be allowed to be offered by regulated banking institutions, not letting it be the Wild West that it is right now. What that's going to do to crypto, values of existing crypto, I have no idea. Yeah. But it's definitely something to kind of keep watch on. And if you are invested in crypto, make sure that you keep aware of what the Securities and Exchange Commission is doing about it. So right now, the Securities Act of 1933 and that definition of an investment contract, when you have passive investors investing in a common enterprise with an expectation of profits based solely on the efforts of the promoter, that is the definition of an investment contract, and that is being applied to crypto. And so the people that So that then gives rise to all these other things in the Securities Act of 1933 that also apply. And so there's a section 17B of that act that is called the anti-touting provision. And what that does is it prohibits publishing or circulating an article or communication for a consideration received without fully disclosing that consideration. So that's what Kim did wrong. She went out and, just promoted it to her followers, and without saying, oh, by the way, I'm getting paid $250,000 to do this.
Okay, so that's where she went wrong. It was the mere fact that she didn't disclose.
It wasn't that she couldn't get paid for doing it. It wasn't that she couldn't do it. She couldn't get paid based on the amount of money raised. That would have been illegal. But she was getting paid a flat fee just to promote it to her audience. And because she didn't say to them, oh, by the way, I'm getting paid $250,000 for this, that's where she went wrong. That's why she got in trouble. So in order to settle it, and settle it without being labeled a bad actor who could no longer raise money or promote other offerings, she agreed to pay $1 million fine. So she paid $250,000 plus, court costs or whatever. So she ended up paying $1.26 million in total to, so she had to disgorge the gain, right? She didn't get to keep the 250 plus the costs that were associated with the enforcement action, plus then $1 million fine. And, then of course, then it became, nationwide news, probably worldwide news, saying what she had done. So until that, I'm sure there were a whole lot of people that weren't aware of these anti-touting provisions, but it does apply even in the context of a real estate securities offering. Right? Yep. Because if someone is raising money from other people, right? So in the private placement memorandum, we're going to spell out all the money that the syndicator is making, who all the members of that syndication team is, and what percentage interest they own. And we're going to talk about all the fees that they're going to earn and all of the share of profits that they're going to earn. So that's all spelled out in that private placement memorandum. So there's no issue with that. It's disclosed.
It's disclosed, yeah.
Yeah, but if you were doing something else, like say that you were also going to be a contractor for the project because you have a contractor's license or you have a property management company, then you'd have to disclose that as well and say, oh, and by the way, I have this third party entity that's going to provide these services and I could get paid some fees out of that. It's impossible to know how much those fees are going to be, but here, I just want you to know so that if an investor objects to that, they have the opportunity to say, well, I don't like it. I don't want to invest. But without, so as long as it's disclosed, it's fine. You can do it. If you don't disclose it, and then later on, you're like, hey, I want to bring my property management company in, but I didn't ever tell the people that I might make money off it. Well, in that point, then it becomes a point that the investors would have to approve. right? Because then you could say, hey, I just want you to know I have this company. I can do a better job than these other people we hired, or I just created this company that I think can do a better job. What do you think? Is it okay with you guys if we do it? And then if you get a majority vote, then you'd be able to go ahead and do it. But here's another context. If you're raising money for other people, right? So these securities exemptions we're talking about apply to the issuer of the securities. That's the actual company that's going to be selling interest to investors. So when investors are investing in a syndicate, they're buying interest in a limited liability company 99% of the time. And so when they're selling these interests, this issuer, this company that's selling these interests to investors, is the issuer of the securities, according to the securities regulators. And
just to interject there, sorry, Kim. It's everybody who's listening last month when we covered this, the issuer is the same as the sponsor or the manager, the entity bringing that.
It's not the manager. It's not the manager. It's the company that's giving the certificates in exchange. So when we create a syndicate, we will usually, I can show you a slide about that if you're interested in seeing how those are.
Absolutely, yes, please. I'm sure everybody wants to see the layout.
Let me share my screen. Here we go.
And so the manager is the individual, right? The company is the issuer, and the sponsor.
Company is the asset holder.
Yes. So let's see if I can get this to. Here we go. Okay, so there's your structure, right? Can everyone see that?
Yes, looks perfect.
Okay, so this is for a specified offering where a specific property has been identified. You're now going to create a company to take title to that property. So we call that the property LLC. That title holding entity is going to become the borrower on any bank loan that would be gotten to help pay for some of the costs of that property. So right now you can get bank loans 65 to 75% of the purchase price. And then you've got to raise the rest of the money that you need, that down payment, your closing costs, things we talked about earlier, your capital improvements, reserves, pre-closing expenses. You're going to raise all that money from investors. And so you're going to have to at least, we like to structure our deals with two classes of members. Not everybody does it this way, but there's always going to be, this property LLC is going to be a manager managed LLC. So when you form an LLC, you have the ability to form it as a member managed LLC or a manager managed LLC. When it's a member managed LLC, all of the members are considered to be managing members. They all have the right to bind the company contractually. They all have the ability to participate actively in all decisions. So they can all open and close bank accounts. So that's a joint venture structure where all the members are actively involved in generating their own profits. But when we're creating a syndicate where we're going to have passive investors that are relying on the asset manager to generate the profits, then we're going to have a manager managed LLC. That asset manager is going to be able to handle the day-to-day operations of that property. They also get to make decisions about whether to buy the property, when to sell the property, and to refinance the property. So they don't need to get input from the other members or the investors on how to do that. So the asset manager is also its members or it itself is going to be the Class B members. So this is the portion of the company that's carved out for those contributing sweat equity. So very typical, we would sell off 70% of the interest in a company to investors who are contributing 100% of the cash, keep 30% of it for the management, and that could range 30 to 50% depending on the type of asset it is. If it's a development project, there's a lot more work for the management, so they may keep a higher percentage of it. For the passive investments, they're probably going to keep more like 30%. So that's typically how it's structured. So there's going to be opportunities for these investors to participate in cash flow. So if it's a fix and flip property, there's only going to be one opportunity to participate, and that's when the sale occurs, right?
Correct. Yep.
So at the time the sale occurs, the investors, if it's just a one-off deal, then the investors will get all their money back plus their 70% share of profits. If it's a longer-term hold, then there's going to be a period of time that the property is owned, and you're going to be sharing cash flow. So cash flow is going to be shared maybe 70-30, but sometimes there's going to be what we call a waterfall that says, well, if we get cash flow, we want to make sure the investors have gotten what we promised them before the Class B or the asset management team starts to get its cut of profits. So there might be some kind of a preferred return that the syndicator will say, well, we're going to give the Class A members an 8% preferred return for the year before the Class B members take their cut. That's going to be determined quarterly, so 2% per quarter, based on the amount that the Class A members contributed. And so there's a waterfall that just says, okay, first cash goes here to class members till they get their 8 for the year. Second cash goes to the manager. And then after that, we go to some kind of a split. So that's very typical from cash flow. So that's going to be the period of time you've owned the property, you're generating income from rental income, right? Rental or what other,
Got a quick question.
yeah.
So basically coming back to the beginning, we were saying, all these typical structures are legal, each one of them. And you can charge the investors 90% if you want to, and if they are willing to. So all of these structures are legal as long as you disclose up front, correct?
That's correct.
If you disclose up front and it's not a good term for an investor, they just won't invest with you.
That's exactly right, because you've got to be able to show those investors that this 10% I'm giving you is going to generate a sufficient return, that you're going to get a specific return on your investment, or this kind of a target. But you can also do disproportionate returns. You could give investors 10% of the deal, but 90% of the cash. So it's all
legal. And it's all legal as
long as it's disclosed, it's spelled out in an operating agreement. The investors review that before they sign on, and you don't deviate from that.
You cannot change midway of how you do it,
unless you get unanimous consent of everyone.
Perfect.
So year 2, if you want to change anything, now you need everyone to vote on it, all the investors to vote, and then you could go from there.
That's right. So the way we do it is that if you're going to make a change that's going to negatively affect investors, you need their input. But sometimes we have clients that come back and say, hey, we want to do this because it's going to be better for our investors. And we let them do that, because we think that it just could be hard to track everybody down and get a unanimous consent from everybody, but 99% of the people want it because it's better for them. So
it's usually a nicer price instead of a bad one.
So to give an example there, say your waterfall is supposed to be a 50-50 split. All of a sudden, manager decides, hey, you know what? Let's just do 70-30. That's beneficial to the investor. You're giving them 70% instead of 50. That's a good surprise, right?
Yeah. And the syndicator has some discretion here to, like they can forego fees. The other way that the syndicator, the asset manager, so I'm using those terms synonymously, asset manager and syndicator, right? They're the people that are putting the group together, and they're overseeing this company. So this property LLC, the issuer of the securities, they're overseeing that company on behalf of the investors and themselves. Right. So if the issuer wants to give, we always tell our clients it's better to under promise and over deliver. Right. So, maybe you only think you're going to be able to give investors a 6% return, but it turns out you get to give them 8, then you can go ahead and do that. Or if the asset manager wants to forego some of his fees and say, well, we had the right to take a 2% asset management fee, but if we do that, our investors aren't going to get the return we promised them. So we're going to just forego that this year, or we're going to defer it until we sell the property. And if there's enough money at the end, then we'll collect it then.
Gotcha. As long as it's, again, for the benefit of that investor, that limited partner.
That's right. So yes, so we use LLC, so we don't typically use limited partners. This is similar to the structure for a limited partnership. It's just the terminology is different. So instead of Class A members, you'd have limited partners. Instead of the asset manager, you'd have a general partner. And the general partner would also be the Class B member.
Gotcha. Okay, perfect. And I know we touched a little bit on the JV earlier. So can you define for us, because I think we did a decent job last month, but I would like to have you, what is the difference, right, when you JV with someone or when you do a syndication? When should you do a syndication versus a joint venture?
So you'll do a joint venture, oftentimes for this asset manager LLC, it is a joint venture, right? So for instance, you two, Hector and Lewis, want to have your own syndicate, you have your own fund. That fund has a joint venture as its syndicator or asset manager LLC. So in that case, we would use a member managed LLC, and that would, could have just the two of you as members, both of you being managing members. It would require that all of you both sign on all of the contracts and things that that company does, versus forming it as a manager managed LLC. And so all the members in a joint venture have to be actively involved in generating their own profits. No one's a passive investor. That is the distinction. So it's usually more than just a voting right. You're not taking control of other people's money. You're not creating this fee structure for management. You're not creating a waterfall where, it goes through the tiers of the different classes of members, because everybody is the same class.
Gotcha. Okay. So everyone in a joint venture has to work towards that common goal.
That's right.
No one can be totally passive. That's the big distinction that you taught us,
Yeah.
which was massive.
In my opinion, I teach people regularly that joint ventures really don't work with more than 5 people, because more than 5 people becomes hard to get a consensus or hard to get people to even participate.
There's always someone slacking.
Well, or they're just too busy, or they don't want to, or, oh, you guys make the decision, but you really can't let them do that.
Team, please feel free to throw your questions in the chat. We will have a Q&A at the end, but please, if there's something you don't understand as we're going through, by all means, throw it in the chat. This is a conversation. We are open to answering the questions as we go along. So before we totally get off the Kim Kardashian topic, how does that violation, what she did, how does that affect the syndicate itself? And more importantly, those LPs, those investors in that syndicate, are they affected at all because they messed up?
In 2 ways. One is we're providing a private placement memorandum in almost all cases where all of that information is going to be spelled out. So there's no issue. Now, if somebody were out at an event and they were talking about it, they weren't, the investors weren't looking in those documents, then they do have an obligation to explain, yes, we're going to get paid for this. We're going to get certain fees. We're going to get certain, share of profits. And yes, so the management team is going to get paid for this. I'm part of the management team, right? That's the kind of thing that you need to do. If you were getting paid some kind of a flat fee for bringing investors to a deal, so there is something called a finder's fee. It's not often used because there's some dissension on whether or not the states actually allow it, but it is allowed at the federal level. But here's the problem with it. The finder's fee has to be paid for an introduction. So all you can do is introduce somebody to a syndicator, and they have to pay you whether that person invests or not.
Gotcha.
Very difficult to get someone to pay if a person doesn't invest, right? And so then if they only pay if the person invests, then it doesn't fall within that finder's rule. So this is really more like the Kim Kardashian thing. She could have said, for every new contact that you get from my promoting your offering, I want to be paid $1,000. But they would have had to pay her for every new contact that reached out to them, whether that person invested or not. So they just opted to say, we'll just give you this one flat fee. It doesn't have any relation to how many people are investing or how many did or didn't or anything. It's just a flat fee. Just promote it. It's okay. So yes, you can do something like that. Yes.
Okay. And does this particular case, that the violation, does that affect that syndicate and the investors in it, or is it just a Kim problem?
I would imagine there were some discussions with that crypto issuer about the fact that they were paying somebody who wasn't disclosing the amount that was being paid. and perhaps they weren't disclosing in their documents that they were paying somebody to promote the offering, because that also would have been required. So, they could have gotten slapped too. I think in this case, the SEC just wanted to make an example that would have some big resounding impact. So I haven't heard anything about the actual crypto issuer being sanctioned for that, but that could come down the road. But yes, if you did something wrong and you paid somebody improperly for promoting an offering, didn't disclose it to your investors, and they got in trouble, then the syndicator themselves could lose their exemption. They could also be fined and forced to pay some fees, fines, costs, and maybe labeled bad actors so they can't raise money anymore in the worst case. But usually that's going to happen when somebody does something bad, they start stealing money or whatnot.
Okay, so Bernie Madoff got labeled as a bad actor, right?
Oh yeah, yeah. So he was actually defrauding investors. So his whole thing,
a whole nother level, yeah.
It was a Ponzi scheme, right? Because he couldn't deliver what he had promised, so he kept bringing in new investors to pay earlier what they promised, and eventually the whole thing came crashing down, and he ended up dying in jail. So.
All right. So what kind of real estate can people syndicate?
Any type of real estate that produces income. And it could, single family fix and flips, long-term hold properties, which could be multifamily, self-storage, industrial warehouses, mobile home parks, really anything you can imagine. I mean, and it doesn't even have to be real estate. You could syndicate a yacht and, or an airplane. So it's just any group that comes together for a common purpose and elects this, management team to promote the offering to others and to run it on their behalf. That really is the structure of a syndicate, and it doesn't have to be real estate, but any type of real estate that produces income will qualify. Things that might not qualify, nonprofits, right? That's a whole different set of laws. Any kind of a nonprofit company does not follow the same securities laws. This is all for income producing assets where the investors are expecting a profit.
Interesting. Okay, so it is typically driven by profit, right?
Yes.
Okay.
Yes. Yeah.
All right. So I kind of knew that you could syndicate just about anything, but the yacht thing, Lou, we're gonna have to talk about that. That's the next project.
You could buy marinas and resorts. You could
basically any asset you can syndicate any type of asset that has to be managed, pretty much. So a fleet of cars, a fleet of airplanes,
centers, yeah. You could do a car dealership. Is it really anything that needs an infusion of cash, and you're going to raise cash from private investors, and then you're going to have a management team that's going to administer the business
and operate. Gotcha. Okay, perfect. Still really like the yachting one. That's more Lewis's alley.
Right. I wanted to do the floating B&B, right?
Yes, there you go. Exactly.
With multiple berths, you just, either park it at a dock or you float it offshore a little bit. People just come spend the night like a hotel.
Yes, that would be fun. Awesome. I mean, I'd probably wouldn't make a lot of money. I'd be there the whole time. I'd be the guy using it all the time. All right, so we talked about the waterfall and how investors get paid, and you touched a little bit about how the syndicators can also get paid. But can you run us through a few fees, just so that if anyone in the audience is, one, thinking of being a syndicator, or two, they're participating in a syndication, they don't get shocked when they see these fees and they don't think it's abnormal?
Yeah, so the syndicator usually gets a fee of anywhere from 1% to 5% of the purchase price of a property, just for acquiring that property, because there's a huge amount of effort that goes into making sure that that deal is viable, finding it in the first place, and kind of all the deals that didn't happen. This is their reward for getting one that does. So the higher the price of the asset, the lower the acquisition fee. So $10 million property might be a 1% acquisition fee. $3 million property is probably a 3% acquisition fee, but a $500,000 property may be a $500,000 or a 5% acquisition fee. So 1% to 5%. There's an asset management fee, and that's usually based on the gross collected income. So this gives the syndicator incentive to increase the income as high as possible, because the higher the income, the higher their fee. So it's usually 1 to 2% of the gross collected income. There can be loan guarantor fees. Sometimes the lenders require that people with net worth equal to the loan amount help sign on these loans. So if the syndicator doesn't have people on their team that can equal that loan amount, they can bring in outside people of high net worth that do that. And so those people need to be compensated. So there's loan guarantees, fees, usually 1 to 2% of the loan amount. A refinance fee, huge amount of effort goes into refinancing a property, repackaging it, getting all the information to the lender. So 1 to 2% of the loan amount is not uncommon there. A disposition fee, 1 to 3% of the sale price. And again, that's for all the effort it takes to package and market that property, work with the new buyer, make sure they get everything they need so they can execute the purchase. That's also very common, 1 to 3% of that sales price. And, so it's like an a la carte menu. You don't necessarily take all of them every single time, but you can. But those are, some of the more common ones that we see.
Awesome. Yeah, the more common ones. But like you said, syndicators may choose to waive some, keep some, and even add some at the end of the day. As long as you disclose it, is perfectly fine.
That's right. And a development project, there's going to be a construction oversight fee. You're going to have to find somebody who's going to become a full-time job to oversee that property, make sure it's happening. So that could be someone from the property management team. It could be someone from the asset management team, but somebody's got to make sure that the construction is happening.
Yeah, it's basically a full-time job. And so the idea is just to compensate the people doing it so that they don't get into trouble because they're not making any money.
Also to compensate them well enough that they don't have to go get other jobs to feed their families, right? If they're not being compensated well enough to pay attention to this investment, then they're having to go out and do other deals or get other jobs. And that isn't, that's a disservice to the investors. So we like to keep the syndicator and the investors' interests aligned by having them both have the, common interests and goals. It doesn't work if the investors are really happy with the cash flow, but the syndicator is not making any money and they're going to have to do other deals. That deal could start languishing.
Of course, their attention starts to go elsewhere to feed their family, and then that cash flow starts to drop, of course.
Not good for the investors, not good for the syndicator. So, one of the things I tell my clients is, I've seen certain like institutional investors I'll sometimes do something like, okay, we have to get all of our money back plus all of our promised returns, et cetera, before you earn a dime. And I tell my clients, don't do those deals. I said, because you have one incentive. You don't get paid till you sell. Their incentive is to string it along. And so you have misaligned interests. If you have investors that have those kinds of expectations, they shouldn't invest in this kind of a deal. They should invest in something else.
That makes sense. Yeah, keep everybody on.
Those kinds of deals are typically going to yield much lower returns. So, go invest in a REIT if that's what you want, because that's their structure. But if you want to invest in these private real estate offerings, and here's why people do, because the typical returns, and this may change a little bit, we may see a drop in this, I expect we will, but historically for the last 5 years, the typical annualized returns that investors realize by being in a real estate syndicate is, mid to high teens. And when I first started doing this back in 2008, we were seeing returns in the mid to low 20s. Right.
Nice.
So that just means, by the time the property sells 5 years down the road, you take whatever you got from cash flow plus whatever equity you might have been given from the sale, add that all together, divide it over the years that you've had the project. That's like a 20% return on your money. So that's a lot of money. So, again, we've seen mid to high teens for the last few years because of the rising interest rates. We may see that dip again. We may be back into the world where we're starting to see some low to mid teens is more the norm.
Gotcha. Okay. So that's good, because that was my next question. So I'm glad that you answered that. And you did mention making sure on the alignment. And last month we had a question which I felt we answered okay, but I would like to have your answer. And I know we've talked before about the sponsors, the syndicators, having a fiduciary relationship with their investors. Can you touch a little bit about what that requires? Because we got the question asked, is it like a licensed fiduciary, sort of like a financial advisor, which my answer was no, which I'm pretty sure it's not, but I'd like to have your full explanation.
Fiduciary just means that the person in the fiduciary who has the fiduciary responsibility is supposed to safeguard your cash better than they do their own. Right. So they're more worried about you than themselves. They should be looking out for your interests first, their interests second. That's really, and if they get that misaligned and they start looking for their own interests and saying, well, you know what, we're not making any money. It's been 2 years. We said we were going to keep it 5, but we're going to go ahead and sell the property because that's the only way we get paid. That would be a breach of that fiduciary duty if, unless there was something else wrong with the property that made it, a right to sell. And sometimes it's not even something wrong with the property. I've had clients that got ridiculous offers right after 2 years. And it's like, okay, we can all triple our money in 2 years. What do you think? Let's do it. Right. But what I tell my clients is anytime you have those kinds of questions and you're not sure the answer, ask your investors what they want, and get a majority vote. Because if they say, yeah, let's do it, then, anybody that wasn't happy with the decision can't come back and blame them.
Gotcha, because you got the majority to go along, and at the end of the day, it's technically for their benefit if they're cutting their timeline short because they hit their target returns.
Yeah, or greater, right? Yeah. So I will say that, and when I saw that happening was after 2010, and people that had invested in 2010 and 3 to 5 years later were getting ridiculous offers on their properties. So, even though we're in this kind of a weird transition time right now, those that poise themselves now to be able to pounce on deals after the hump occurs are going to be in a really great position 3 to 5 years down the road. Because real estate is very cyclical. We actually have a report that we had our professional journalists create for our clients that's called 100 Years of Real Estate Investing versus Stock Market Returns. And the whole point is that, real estate, it's always an upward curve. It dips, but it always goes higher than it was before. Right. So in 2010, we had single family stuff dropped 50% in value. Commercial stuff dropped 30% in value. And of course, it was dependent on where you were in the country. Coastal areas always recover faster. Yes. Okay. Vacation areas sometimes don't drop at all. Middle of the country tends to dip hard. And yeah, Florida got hit very, very hard last time just because there was so much of it. Right. Yep. But eventually the real estate came back, and it came back higher than it was before.
It came back roaring.
Yeah. So you just, the trick in the real estate game is that it's cyclical. There's usually like these 8-year down cycles and 8-year up cycles. You just have to be able to ride it out. So you don't want to be caught with a loan coming due in the middle of a downturn. Right, where the property value is depressed lower than the loan amount, and now you can't get a loan to get out of it. That's what happened to the people that got in trouble in the last recession. Is some of them, the property values were depressed. They had short-term loans. They were coming due. They couldn't refinance. They had to let them go back to the bank. Yes,
correct. So a couple tips there, team, to guard against that. Number one, keep your LTV, your loan to value, low. Like we talked about earlier, 65%. That's a really good number. You could take a major hit in the market and still get out from under that property, pay your lender back, and those longer maturities, right, Kim? Yeah. For those longer maturity dates. You don't want a 3-year maturity right now with what's happening. That's very dangerous. And sadly, I see plenty of deals out there being marketed with three-year maturities, and it scares me, honestly.
Well, and you've got to be careful because a lot of people will do these 3-year loan maturities with 1-year extensions. So they call it a 3-1-1, right? Yeah. 3-year. But look at what the criteria is for the extension, because that's where you're going to get caught up. It's like, well, you can get the extension if this is happening and the loan to value ratio is this and this and this. Well, you may not have that. So what you really want is, hey, as long as I'm paying my bills, I get to extend, right? If I haven't missed any payments, I've been paying right on time, I get to extend. That's what you want. It shouldn't be based on these other external kind of arbitrary factors that you can't control, if there's a way to get that done.
That's an absolute great point. So if you're a syndicator, read that fine print on the loan extension. And if you're investing on a syndication, ask them if they read the fine print on that loan extension.
Well, and you can always ask for the loan box and say, could I take a look with the loan docs. I want to make sure I do that, and I've seen some people do some really weird deals where, they've got some strange provisions in there. You just have to be careful.
Yes.
Sure. Gotcha.
All right. So let's keep going down that same path, Kim. Where can people go to meet syndicators so that they can potentially invest with them?
Real Estate Investment Association meetings is your best local source, right? Every major market in the country has RIAs, they're called REIA, RIAs, that meet once a month. Some of your bigger metropolitan areas will have 2, 3, 4 different ones that you could go to. They usually meet during a week evening, like, Tuesdays at 6 or Wednesdays at 6. So I always recommend that you try to go to as many as you can, at least initially. Figure out which ones you like, because there could be some that just kind of have maybe it's too for profit that for your tastes, or, they're too salesy, or you just don't care for the people that are organizing it. Find the ones that seem like the people there are, like you. A good fit, you like them, you like hanging out with them, you become your friends, you're going to develop a lot of relationships with people, and you've got this little social event to go to once a month. Just realize that a lot of people there aren't serious about doing anything. They're there for the social value, right?
Nothing better to do that evening, and the drinks are good, right?
So Ron LeGrand is an old syndicator from Florida. He originated up in Jacksonville, and he was doing the nationwide circuit for a long time. I saw him speak at Jacksonville RIA one time, and he said, at any local real estate investment association meeting, you've got 7% of the people that are doing something, 7% of the people that are on the verge of doing something, and the rest are there for purely entertainment value.
Wow, that margin is kind of low.
So you got to figure out. Well, I heard like at these nationwide real estate events you go to, it's more like 3% are doing stuff, 3% are on the verge of doing stuff, and everybody else is just there because. But I don't know. My experience is that the people that you meet, like if you go to a nationwide event, there's some big ones, right? There's a big one coming up. Gosh, is it next week already?
Yep, we'll be there.
Wow.
We'll see you there, Kim.
November 5th and 6th in Orlando at the Gaylord Palms. This is Jake and Gino's multifamily mastery 5 event. That event is going to have like 1,000 people in it. All right. So if you want to be in, a big energized group and meet a bunch of vendors that can provide stuff to syndicators and get a lot of different education from some high level speakers. Last year, they had the head of Marcus and Millichamp and the head of Coldwell Banker there, giving their forecast for what was going to happen in the next couple of years. So, you can learn some really high level education stuff. You can meet a ton of the other people there. Many of those are going to be other syndicators that you could partner with. Many of them are going to be other passive investors. They don't necessarily go around with signs saying I'm a passive investor. So you got to talk to people and get to know why they're there and what they're interested in. They'll tell you if you have a conversation with them. And then you have to, your whole job, if you go to one of these events, is not to hand out business cards, regardless of what you think, because nobody's going to follow up with you the way you want them to. So it's to gather business cards, and then you follow up with them and ask them, hey, we had this conversation when we were at this event. This is like dating, right? You're meeting people at a live event with a ton of people. It's not the time to, make a proposal, a marriage proposal, but it is the time to gather contact information, wait the obligatory 3 days, follow up. Hey, we might want to have a follow-up conversation, see if there's a way we can work together. What are you looking for? Make a conversation about them, right? The worst date in the world is all about you. It's about them. So best date is when they want to know about you. So, or you want to know about them. So, ask them what are they looking for? Are they passive investors? Are they looking to partner on deals? Do they have deals? Do they know a bunch of people with money? You might want to bring them into your asset management team if you know somebody that knows a bunch of people with money. So they can become part of that issuer, and they can legally raise money for your deal and get compensated for it as part of your management team. So, and then also loan guarantors, right? You're going to meet people there that can help you guarantee loans if you want to buy bigger properties than what you could afford to guarantee on your own.
Perfect. And now you did make a really good point. It's like dating. This is a long-term relationship. These typical syndications, correct me if I'm wrong, Kim, it's anywhere between 5 to 7 years on average. They go sometimes as long as 10 years. So you gotta like these people.
Yeah.
You're about to get married for at least 5 years.
That's right. That's right. And the wrong investors in your deal can really sour it for you and everybody else. So just, be cautious, make sure that you have, patient people that are, reasonable and patient people that understand that these things all take time, that things don't happen overnight. You don't want nervous Nellies, or people that are very impatient, or people that think they can do it better than you.
Yeah, good point. People that think they could do it better than you. That's awesome.
Because they probably haven't, they may have no education about this whatsoever, but they just think they know everything. And we all know people like that, right? And then there's also people that can't be helped, right? Okay, some of those I call loved ones.
Yeah.
So you just have to be careful. The people that are at your Thanksgiving dinner saying you're crazy to do a real estate fund. Well, you know what? They're not going to be good investors for you. You don't want them.
That's not a good investor. Absolutely.
No, and don't listen to those people because, as you're going off and making your fortune and they're still doing their jobs and not making any money, they're gonna, whether they ever realize that you had the right answer or they did, it doesn't matter. You're just going to go off and do your own thing. So don't let those people weigh you down.
Absolutely. Good tip there.
Mhm.
Okay. I got
Kim,
another. Okay.
Go ahead.
Okay. So I got the other question.
I'm on fire. I just keep firing questions.
Yeah.
I'm just like, I get excited.
No, and the other questions that we were talking about, okay, you're getting married with someone for 5-7 years. Actually, sometimes they last longer than a marriage. What are the easiest red flags that you can spot for a bad syndicator? Like, so they're bringing me something, I'm looking at it. What should pop kind of immediately? So say, hey, you know what? No, I'll call you later. Bye.
So the first thing is, ask about their past experience, right? With that same kind of thing, right? So ask them, how many of these have you done before, right? How many, if they're doing fix and flip, single family fix and flips, how many have you done before? And it doesn't have to be them specifically, but their team collectively, who have you assembled with this right experience, right? And have you ever dealt with investors before? So there should be someone on their team that, that has the kind of experience that you want to be part of. So make sure they've got the right, we call that a track record. Ask them, hey, what kind of securities exemption are you following? If they look at you with a blank stare, that's going to be a red flag, right? Because they should know exactly they should be able to tell you 506B or, Florida rule, this or that. They should be able to tell you the specific citation to the exemption that they're following. If they don't know what a securities exemption is, then they're probably not raising money legally. And so again, this would be helpful if you read the book that I wrote, the How to Legally Raise Private Money, to get a better idea of what those exemptions are. There are exemptions both at the state level and at the federal level. If someone is doing a Florida securities offering, then they should be raising money only from investors in Florida. The property should be in Florida and they should be in Florida. If they are crossing state lines, then that's when usually people go to the federal exemption because it supersedes all the individual state laws. So then you can just follow one set of rules. Yeah. So, look up, do Google searches on people. Absolutely. The Google searches on people will tell you a lot, right? And look at pages 2 and 3 and 4. And here's why. Because if somebody has had a bad reputation or they've done something wrong and a bunch of people have complained about it, they will hire a reputation manager that will put out a bunch of, positive stuff out of them to push all that stuff back. You may still find it. So go past page 1.
Past page 1, yeah. And I mean, I think you said it at some point, is that make sure that they've passed that bad actor background check and that they're clean to raise this capital. I know that your firm, the practice is, to get everybody's background checked on the management team, but not all attorneys do that. Am I correct?
No, they're required to make an inquiry. They're not necessarily required to make an actual background check. We've just decided to make it a policy, both for our protection and for the protection of our clients, right? Because you might have just met somebody at your RIA or at one of these nationwide events, and it seems like a good idea. They got a deal, and you've got some investors. You're going to come together, but until we know, you might want to know, hey, what were the results of their bad actor check, right? Are they okay? and they're not, and you might feel uncomfortable saying, hey, can I do a background check on you? Or, or they may not want to do it. So rarely do people do their background checks on each other. So we're just kind of helping to facilitate that so that our clients know everyone on your management team has been vetted. And if they haven't been vetted, then we're not going to name them in management. And so they don't have the ability to go out and promote your offering.
Perfect.
Awesome. Yeah, that's very important. And I was actually very glad that you made us all do that.
Good. Yeah, and we have, and it's surprising because we just started that policy about a year ago, and we really haven't had people object. I thought we'd get a lot more objections, but I guess the people that don't want to go through the background check just say, yeah, well, I can't do this deal after all, and they just kind of go away.
Yeah, you would think that if they're on the up and up and they're coming to you, a good attorney, and they're going to be okay with the background check. They're, if they don't want to do a background check, they're probably just doing the deals in the back room, making their own PPMs at home.
Well, and the background check is going to check for litigation too, right? So sometimes somebody's already been sued by another investor or something like that. I mean, we've had, we've had some people that, later on we're like, oh, gee, maybe we should let those people syndicate, but sometimes it's too late. So that's kind of why we did that.
It's awesome.
Yeah.
All right, team, we're going to open it up for Q&A. So please drop your questions in the chat. In the meantime, Kim, thank you so much for being here, sharing all this amazing knowledge. I definitely learned a few more things, and I know the audience is very thrilled and learned a bunch of stuff as well. But how can people reach you besides calling me to ask me for your number?
Syndicationattorneys.com. There's a place to schedule a consultation. You can, if you click that button, you'll get an option to talk to one of my staff, or if you want to do a paid consult, you can do schedule one directly with me. So, that's probably the best way, I would say. Or, you can reach out. We have a great business development team. We have other attorneys that work with us. So, they're able to give you the same kind of information. It doesn't only have to come from me.
Absolutely. And that is the link to the website, and the book is in the chat right now. Louis put it in, and I can personally attest to the strength of Kim's team. It's, she's obviously the brains behind the operation, world-class genius, but her team is amazing. I've had the pleasure of working with several of the teammates, from the design crew to the attorneys, and they're all fantastic.
Yeah, we've
done a really good job building a heck of a team, honestly.
Yeah, we've got a securities attorney on our team that's been practicing securities laws for 25 years. We've got, another attorney that's been with us for 5 years, practicing securities law. She has almost has a real estate development LLM. We have another paralegal that's been with me for now almost 13 years.
Wow.
Yeah.
That's great. Absolutely. All right, let's see. What do we have? Okay. All right, it looks like we covered those questions already. And so if nobody else has any other amazing questions, we can wrap it up. I'm sure, Kim, you have a lot of fun stuff to go do. So thank you so much once again for being here. Really appreciate it. Please go out and check it out. How to legally raise private money.
That's right.
Jay Linderman says, thank you for the great content. I'm sorry, Kim, you were going to say?
No, that's okay. Yeah, sign up for the book for want the free digital copy at our website. Then eventually we're going to be coming out with a second version of the book hopefully by the end of the year. And we're going to be sending out soft copies of that. So if you sign up for the digital copy, then we'll let you know when that's coming and what you need to do to get it.
Yeah, and the podcast too. The podcast is really great.
It's on 20 different podcast platforms, so pick the one you want, or it's posted on our website. If you go into our library, there's over 60 different articles. So syndicationattorneys.com, go into the library. There's articles, frequently asked questions, and all of our past recorded podcast episodes are there. So lots of ways you guys can learn for free. And then if you want to become a client, we do weekly syndication masterminds. Hector is a regular at our events, and we love to have him on those calls.
Yes, and those are great too. I've learned so much. Like I said, it's crazy how much my brain keeps expanding each time I show up. Somehow you manage to bring the content, and just the people there are great because it's a bunch of other syndicators that are all going to similar things.
Well, what I've seen of the people that have been coming to the masterminds is I've seen their confidence really grow. And so the more education you have and the more confident you feel that you're doing things correctly, the more likely you are to be able to go out and do it without feeling afraid of it. So that's our goal.
You bet, absolutely. Especially when it comes to the SEC, nobody wants a $1.2 million fine. So
no, no, not all of us can withstand that.
Absolutely, it could definitely be brutal. So once again, team, on your screen there, you should see the website, the book, and the podcast. That's how I'll give a big round of applause to Kim. Standing ovation. Thank you so much.
Thank you so much.
Thank you.
Sochi says thank you. This was great. Thank you for joining us, Sochi, Jay, everybody. We really appreciate it.
All right.
All right, Kim. Have a fantastic day.
Thank you so much.
Thank
All
you.
right, take care.
Bye.
All right.
All right. So we finished that up slightly early, which is amazing. Very
Yes, yeah.
rare for us.
First for us.
Can you believe we did that? You know, definitely Kim did a good job of keeping us in line because, you know, we tend to wander off, but the information was great and it worked out. So just a couple of things before Yates walks in and takes over, which, well, I believe today's Yates. I'm not 100% sure. We will be starting a new mentorship group in January, and the details of that are going to come out just right before Thanksgiving, so you guys will all see that on the website. So please check it out. I know there's been a lot of questions. I've gotten a couple of emails and several requests for some mentorship groups, so please keep an eye on that. We will be dropping some more information. We don't have all the details yet, but I can tell you that it's going to be starting in January.
That's right.
So
what else? If you have any other questions, you got any other comments, if you want to see a recording of this video, we also post them on Slack. If not, all the recordings and everything are on reallifetrading.com/RE. That's a real estate side of the real life trading. And all our videos are there. And if you have any questions, any comments, you want a topic, you want to learn from something else that, you know, have any ideas that we can put in the show, realestate@reallifetrading.com. That's our email right there. You can reach out to us, and if you're not on Slack or, you know, on a daily basis with us. That's it. So if you are in YouTube, please like and subscribe as usual. That will bring us up in the count, whatever. YouTube
and mostly it just makes us feel really good about ourselves. I do check.
Yeah,
I go to YouTube and I go like, how many
Yeah,
likes do we get? And then I'm texting Louis like at 2 a.m. Oh my God, we got 5 more likes, dude. Please just do it for me, for my own ego. Just click it. And if you're not subscribed, you should absolutely be subscribed because we put out pretty decent content. But the rest of the team here at Real Life Trading, they put out some fire, guys.
Amazing stuff. Yes.
Don't miss out on it. Hit that subscribe button. So thank you so much for joining us today. If you're watching the recording, we're gonna stay live with the rest of the crew here, but I'm gonna shut off the recording. So thank you once again. Have a fantastic rest of your day. Real estate at reallifetrading.com. reallifetrading.com/RE. Thank you all so much.